Hello, everybody. How are you? It's Garrick. We're here. Just the Tip Tuesday. On a Tuesday with...
My name is Christopher.
It's just Chris.
Just Chris.
Chris Cornish. Chris, licensed mortgage officer.
No, mortgage loan originator is the term I like to use.
We're here with Chris. We're going to answer some questions. We're going to answer the most frequently Googled questions about mortgage. Go ahead, Tom. What are we talking about?
Okay, the first question is, how much mortgage can I afford?
Chris, how much can they afford? Let the people have what they want.
Well, what's allowed and what you can afford are two different things, but typically it's a debt to income ratio of 43%. So they will look at your annual income divided by 12. You can multiply by 0.43, and then that will give you your debt to income allowed, and then you make that determination.
43 is for a conventional loan. If you're a VA loan, if you're an FHA loan, so a veteran loan or a first-time home buyer loan, there's some other options that could make that debt-to-income ratio higher. And also, you would need a rate to determine, if you have, okay, I can use 43% of my income towards a house payment. Well, if you don't know your rate, you can't calculate your house payment. So there's a few factors that go into that, which would be like credit, interest rate, down payment, before you can figure it out. If you talk with one of our licensed lending agents, it takes just a few minutes to figure out and get a general idea. And if you hang around for a few more weeks, we're going to be launching a pre-approval calculator. So you'll be able to go to our site, you'll be able to put in a few basic things and have a real general idea of exactly how much you can qualify for very quickly. What's next, Tom?
What is a mortgage and how does it work?
Well, let's leave that to the guy in the suit because you obviously know about finance.
A little bit.
Is that a Rolex?
It is not a Rolex.
It looks like a Rolex.
One day. So what is a mortgage? Well, it's a loan taken out in order to purchase a home, a condo, an investment property. And how does it work? Well, basically, there's a few different factors that go into getting a mortgage, but a lender or a banking institution will loan you money in order for you to purchase a home or some sort of property.
They loan you money against the value of the collateral, which would be the property, the house, whatever it is. And if you default, they get that back. So if it's worth $100,000 and they loan you $50 and you default, they would technically get that house back and they could sell it or auction it off for $100,000. Which is why if that were the scenario, your loan to value would be 50% since you only loaned $50,000 on the full $100,000 value. And that's why the more you put down, the less risk there is to the bank, because at the end of the day, if you default, they're going to get their money back and then some.
What are current mortgage rates?
Low, or than they have been. What are current mortgage rates? Well, they're based, every single rate there's a risk factor associated with each borrower, and there's a price in the market that changes daily to determine what those rates are for different investors, different portfolios, different terms of loans, like a 30-year loan, a 15-year loan. They would all follow different indexes or yields. 30-year is really close to the 30-year treasury bond, while 15-year loans or any adjustable rate mortgages or an ARM that could be a much shorter term would have other indexes like LIBOR and other things. So the rates move with the market.
How much will my mortgage payment be? I don't know if you can answer that.
Yeah, we can.
Okay.
Call us. Your mortgage payment will be your principal and interest payment. So whatever you're loaning, so if you're purchasing a house and you're putting 10% down, you're going to be financing 90% of that value. Whatever your interest rate is, amortized over 30 years, APR, will give you a principal and interest payment. And on top of that, you're going to have homeowners insurance, and you're going to have property taxes. You could either pay these escrowed into the loan, so you pay one payment monthly, or you could pay them quarterly or annually outside of the loan. And then if you put less than 20% down, then you're going to have mortgage insurance on top of that. And that'll compromise your total payment.
Okay, and that goes into the next question. What is private mortgage insurance?
PMI. What is it?
It insures the mortgage amount. So if you have a loan to value higher than 80%, you pose a greater risk than if you were under that value. So if you're over 80%, you have private mortgage insurance. If you go below 80%, you can cancel it, and if you go below 78%, it will drop off automatically. That's if you're with a conventional loan. If you have an FHA loan, that mortgage insurance stays for the
What does
life of the
FHA
loan.
stand for?
Federal Housing Administration.
Wow.
Yeah.
Pretty good.
So if you have an FHA loan, that mortgage insurance stays for the life of the loan. So that's why you would either not want to go with that in the first place, if you're able to avoid doing so, or you would want to refinance after that point.
So mortgage insurance, it's paid by the borrower or the lender?
It's paid by the borrower.
So
It
the
depends.
borrower is paying for insurance so that if they default and the bank can't get all the money back that they loaned them when they auction the house off, that insurance pays them that difference.
Exactly. Now,
Okay.
if you go with a USDA loan or a VA loan, then it's fully insured by the government, so the consumer does not have to pay any mortgage insurance in that case.
But the bank is still covered because the government pays for the insurance. If they default, then the government insurance kicks in and pays the bank back so that they're not losing money.
Exactly.
Interesting.
How do I get pre-approved for a mortgage?
You go to syomortgage.com, or you may call me at 657-220-6163, and I will do everything I can to get you pre-approved.
A pre-approval, you would fill out an application, and then that would establish creditworthiness and ability to repay. You would verify that with documentation such as income and assets for proof of down payment, and to provide the income to prove ability to repay. And that'll get you right on the way to getting a pre-approval. Pre-approval is something every realtor is going to want before they show you properties, because it shows your ability to purchase. So if you have a pre-approval, it's like, hey, I can purchase or I can make an offer if I want to. And so most realtors, before they go show you properties, are going to want to see that, because that means you've taken a serious step towards purchasing a home.
How do I pay off a mortgage faster?
To pay off a mortgage faster, so there's a ton of interest that's accrued in the early years of a mortgage. In fact, on a 30-year mortgage, we'll put the actual stats up, but I think if you make one extra payment per year for the first 5 years of your mortgage, is a 30-year fixed rate loan, it ends up shaving about 7 years off the end of your loan. That's how much interest is accrued up front. So if you pay anything above and beyond your principal and interest payment, that can go directly to principal at a 0% interest amount. As long as you don't have any prepayment penalties or anything like that, you'll definitely be able to pay off your mortgage faster if you just, throw some extra money at it. You could also refinance for a lower term, a lower interest rate, and pay it off faster that way.
How do I refinance a mortgage?
I'm going to go back to my previous answer. You just call me at 657-220-6163. No, but it's the same process as if you were to purchase a home in a sense. So we would make sure that you're qualified, obviously, and then we would just see who offers the best rates on the open market. But it's a little bit simpler process.
Because you want to avoid fees. Because if you're saving money in the interest rate, but you're paying a couple $1,000s in fees, then it's going to take years for that savings to come into effect in reality. So that's what you want to be cognizant of in a refinance. A refinance.
Last question. Can I get a mortgage with poor credit?
Yeah, Chris actually got a mortgage. I'm just kidding. Go ahead.
Yes, you can absolutely get a mortgage with poor credit.
Who should they call?
They should probably call me. I'll get you approved. No, but on a serious note, you can definitely get approved. There's a number of different ways of going about it. So the minimum down payment is typically 3%, 3 to 3.5%. Now, if you fall below that threshold in terms of credit, you might need to put a little bit more money down. So certain
It's
lenders,
usually like below 580, below 550. If you're near the 500 range, you pretty much need 10% or more down. There's some special cases, but the answer to any bad credit is money down.
or a cosigner.
Or a cosigner. Exactly. Money down. Because the more money you put down, that is the less risk you are to the bank. If they're like, hey, you need the house is worth $100,000, but I'm going to put $50,000 of my own dollars down, but you have horrible credit, and they're only going to loan you $50,000. there's a much higher likelihood of them doing that than if you were like, hey, I need 95, I have $5,000 down. Nobody's going to loan you the 95,000. Just think of it as your friend, and your friend's asking you for money. And you're like, okay, well, you don't have much credit and you don't have much cash, and what if the house only sells for 90? Then I loan you the money and you default, I lose $5,000. It's where if I loan you 50, and I sell it for 90, I still profit $40,000 if you default. So it's much less risk to me. Are we all done? Is that all the questions?
Yeah.
Okay. Until next time.
Just a
we
tip.
appreciate everybody watching.
We
If
do.
you have any comments on Christopher's outfit, his attire, his smile, his eyes, his hair, he's open for the compliments, and boy, does he take them well.
I do.
See you guys later. See you next week. Talk to you soon.